China's central bank has kept its key lending rates unchanged for the fourth straight month, signaling a cautious, steady approach to monetary policy. The decision, announced on September 22, 2025, means borrowing costs for households and businesses remain the same amid a complex economic landscape. This move follows a similar hold on the 7-day reverse repo rate, reinforcing a deliberate pause to let previous measures take effect. The Chinese economy is sending mixed signals. Some sectors show resilience, while others slow, so policymakers are choosing stability over sudden action. Experts widely expected this outcome. A Reuters survey found all 20 market participants predicted no change, reflecting strong consensus. The central bank's clear communication and measured strategy have made its intentions transparent to markets. For now, China is prioritizing stability, waiting to see how the economy responds before making further moves. To understand China's decision, let's look at the loan prime rates, or LPRs, the benchmarks for most lending in China. The 1-year LPR, at 3%, affects short-term business and consumer loans, while the 5-year LPR, at 3.5%, is crucial for mortgages. Keeping these rates steady supports both business activity and the housing market, which has faced challenges recently. LPRs are set monthly by 18 major banks, influenced by the central bank's medium-term lending facility rate. This system, reformed to be more market-driven, still gives the central bank strong indirect control over borrowing costs. By holding both LPRs steady, policymakers signal confidence in the current balance between growth and stability. The unchanged rates suggest the cost of money is appropriate for now, supporting the economy without fueling bubbles or inflation. China's central bank is content to observe before making any further adjustments. Several factors shape the decision to hold rates. Easing US-China trade tensions and a strong stock market have reduced the urgency for more stimulus. The Shanghai Composite Index is near 10-year highs, reflecting investor confidence and lessening the need for monetary easing. However, domestic data shows factory output and retail sales are slowing, creating a dilemma for policymakers. Cutting rates could help but might also risk financial instability or asset bubbles. Meanwhile, resilient exports provide a buffer, reducing pressure for immediate action. The central bank is weighing strong markets and exports against weaker domestic activity, choosing patience over haste. It's a careful strategy: wait, watch, and avoid sudden moves in a complex environment. Most analysts see this pause as temporary, expecting monetary easing before year-end. Weakness in factory output and retail sales may force policymakers to act if conditions don't improve. Many predict a small rate cut, about 10 basis points, in the fourth quarter, signaling support for growth. A cut to the reserve requirement ratio, or RRR, is also likely, injecting more liquidity into the banking system. The timing depends on economic data and US-China relations. A successful diplomatic summit could delay easing, while setbacks may accelerate it. For now, the hold is a strategic delay, giving policymakers time to assess and preserve options. The consensus further support is likely needed, but the central bank is waiting for the right moment. The fourth quarter will be critical, with every economic and diplomatic development under close watch. China's steady rates bring predictability for households and businesses, supporting financial planning and stability. By holding off on cuts, policymakers show confidence in the economy and help prevent excessive debt or asset bubbles. This approach prioritizes long-term stability over short-term stimulus. Globally, China's monetary policy ripples outward. Stable rates mean steady demand for commodities from developing countries. International investors and companies value the predictability, which supports foreign investment and global supply chains. China's pause is a global event, influencing everything from commodity prices to investment strategies worldwide. The decision underscores China's central role in the 21st century world economy.